I am David Stites, CFP professional with Fidelis Financial Strategies. Why is the stock market recovering faster than the economy? So some of that is, yes, we are in a time where we had a pretty dramatic drop. In March, the stock market dropped 30-something% if you were in an aggressive kind of a holding where it was large U.S. companies. And so we had a dramatic drop in a short period of time. Our company was proactively reaching out to communicate with clients. We were sending out videos, updates, kind of telling you about what's going on. But during that time, we wanted to, because there was so much uncertainty with what this COVID virus was, how it was going to react, then generally the market, because there's that uncertainty, is going to drop with the unknown. The market doesn't like uncertainty. And so as it kind of looks forward, because it is a leading indicator of what it thinks is coming down the road. And so as there was some clarity to COVID-19 and maybe how to treat it, maybe what some therapeutics were, progress in a vaccination. The market doesn't wait on the news to tell you, oh, there's been a few more people hired, or we think that there'll be a vaccine in the next 90 days or whatever it is. It's already predicting where it thinks we're going to be down the road. And so oftentimes, if the market has recovered some, it's because they believe, and they is a very broad term, it's a very complex world thinking of pension managers and individuals and all kinds of reasons for the ups and downs. So sometimes you hear bad news that day, but the market goes up and it makes no sense, but it's because it's looking forward down the road. And as it saw some clarity playing out, then it's recovered a lot of what it's dropped in March. But some of that is all concentrated into just a few select companies. So as you can imagine, when we all got contained to our homes and we're not allowed to go anywhere, those companies that benefit from you being at your home with nothing more than a computer might have done better than, say, a retail mall where you go and you hang out, or a restaurant that's known for social interaction. So I was going to read this stat. In 2020, 5 stocks known as, they call it FANG, but you can imagine what those are: Facebook, Apple, Amazon, Microsoft, Google. They turned in a 244% return over the past 5 years. The other 495 companies in the S&P 500 had a combined return of 41%. So as you can imagine, a lot of this growth is centralized in just a few companies, which is somewhat similar. Some of the pricing right now in stocks is concentrated in those areas. And so it's very similar to like in 2000, where you had a big growth in stock prices and what they would call the dotcom bubble. And some of the pricing right now in stocks is very similar to that time frame, but we are 20 years later. And so rather than the market betting, oh, you've got .com after your name, you're gonna do great, we're gonna spend lots of money on your company, and then it was a startup and it failed. Now you've got some pretty established companies that have been going for a while, and those companies are doing well, they're showing a good profit, but we're paying extraordinary amounts of money to be an owner in some of those companies. Now, will it kind of phase back into, we may be forever changed, but certainly as the economy that feels a little broken right now starts to get a rhythm again, some of these stops and jerks start moving again, then I think you'll see more traditional companies begin to recover. Overall, we just want to help as a firm to get you where you're trying to get to. Just have a heart of a teacher. And so if you have any questions, if there's a way that we can help, make those little steps along the way. We'd love to be a part of that process. You can reach us on our website, or feel free to call us and we'll set something up that works with your schedule via call, video chat, or in person. We're good either way.